Good afternoon, good evening around the world. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. We have a lot of optimism around 2021, and one of the areas of particular interest and specific optimism is on mergers and acquisitions. It's actually not been a terrible year. It's been, as I understand it, a down year. I'm sure we're going to hear a little bit more details today from our experts. We're going to have a conversation about kind of where we are, what some of the factors are in the market, and then they're going to give us an outlook on what's going to be happening in 2021 so that we can be ready. We were just chatting offline, and it seems like there are a number of stars aligning in the clear Wisconsin skies for us to see that 2021 is going to be a pretty spectacular. And I mentioned Wisconsin because the person I'm going to introduce first is based there, but does business around the world. So we're looking forward to his and all of our experts today. Let me first introduce, kind of on a macro level, each of them. I'm going to first introduce Scott Bushkie. He's the founder and president of Cornerstone Business Services. He's the one that's based in Wisconsin, but his head is around the world every day. And then we have two people from BurgherGray, both Christopher Klug, who's a partner, and another partner, Sandra Honegan-Pounder. They're both going to be participating in a conversation. And this is kind of one of those fun Globinars where very often we are very much coordinating like timing and what's going to happen. Well, these three people, I'm not sure they knew each other, but they put together basically a 40-minute presentation, and so we're going to have 40 minutes of content and then 20 minutes for Q&A. So I'm really happy that we have within Global Chamber experts like this that we can count on to help guide us for our next steps. And this is a topic that should be of interest to everybody. So Scott, thank you so much for participating and leading this conversation. Christopher and Sandra, thank you as well. I'll turn it over to you, Scott. Please go ahead.
Thank you. Very much glad to be part of this. Chris, do you want to kick off your firm or Sandra?
I'll let Sandra give the overview.
Oh, you're muted, Sandra.
We're off to a great start so far.
I'll give the overview. So BurgherGray is a law firm that's...
There we go. Sorry about that. So BurgherGray, we're a boutique firm made up of mostly lawyers who worked in prior large firms. We used to call ourselves big law refugees. But we are a full-service law firm that provides general corporate commercial transactions, complex commercial litigation, and M&A, intellectual property, tax, estate planning, and so general business finance, and also public finance services. We're about 30 attorneys strong. We have offices in New York, DC, where Chris is located, Chicago, and also in Miami. And I head up the M&A group of the firm.
Thank you, Sandra. And just a little bit about Cornerstone. So yeah, we're a boutique investment bank, as Doug said. So we work with business owners that are typically privately held businesses, family-owned businesses that are looking to maximize what's important to them or sell their business, transition to the next chapter. Private equity groups, family offices, and companies that are looking to growth through acquisition. And then also business owners that are looking to get an idea of what their business value is. And I think more economical standpoint, we could do those at a much lower cost than going out and getting a certified valuation that's going to cost you probably $5,000 to $30,000. We're as Doug said, we're located here in Wisconsin. We've got some offices around the country, satellite offices, but we've got 8 investment bankers and 7 management and support teams. So a team of 15 that work domestically and also internationally. So we look forward to speaking with you today. And, as what the three of us really want to cover is if you're looking at growth through acquisition, giving some different tips or different ideas of how to do that and not make some of the mistakes that others make. And then we'll flip the page to sell side, for business owners that are looking to maximize what's important to them or transition it to that to the next generation or management, or selling to a third party? What are, again, some of those common mistakes or things to watch out for? Because again, as the three of us talked offline prior, this is such a everything is done is confidential. It's very non-transparent. So, you can't just like selling your house, know what all the comps are very easily and tell everybody about it. You want to keep things confidential so your competitors, your employees, and your customers don't know that you're thinking about selling your business or what it might be. So that's what we want to really get into today. And we're going to keep this interactive between the three of us. And then after about 40 minutes or so, we're going to open it up to Q&A and cover any questions that you might have. So first, let's just talk about some of the acquisition tips. So you're looking at growth through acquisition. The first one I've seen out there is, don't just grow for the sake of getting bigger. We're going to grow. Well, what are you looking for? I don't know. I'll know it when I see it. I've seen that strategy many times, and it's usually you can spend a lot of time and a lot of money and have very little chance of success. So really take the time to understand, what are you trying to do? Are you looking to grow market share? So you're going to grow into a different state with someone doing the same things, or are you looking to buy a company where you can sell to the same customers but different products, or to reduce customer diversification? There's a lot of different strategies, but just making sure you pick one and you really think about it and it's vetted out. The second one is having your deal team in place. What I think you're going to hear from Sandra and Chris as well is that there's a lot of buyers out there right now. So if you're trying to compete on the buyer front, to kind of find something and then try to put together your team, you're probably going to miss out on that opportunity. So who's part of that deal team? And these are your typical deal team members, and there could be a lot of others, but making sure your partner, your lender, you've talked with them about what you can and can't do and what that might look like, what the source and uses of funds might need to look like. The investment banker to really, again, help find those proprietary deals out there versus just waiting to see what's on the market. For instance, we just took a company to market right after September Labor Day, and we had 120 signed NDAs on a deal, 12 million in sales and 4 million in EBITDA, and we got 28 written offers. So again, you want to make sure that you're going after that proprietary deal flow and having an investment banker that can help you do that. The M&A attorney, this is where Sandra and her team come in, where this is not, hey, I'm going to do this with my attorney that helped me set up my LLC, maybe help with some collections and does basic corporate type work. This is the brain surgeon. You want to bring in the hired person that can really do this and do it very well, because otherwise, again, you can spend a lot of time and energy and money with little chance of success. The CPA to come in and do the tax analysis and also do all the QOBs and other things to make sure that the financials are, what they should be from a GAAP standpoint. And then others are HR is a big one, especially now with COVID, making sure that what that looks like, insurance, environmental, and the list goes on. But I think the takeaway here is build that team before you go to market, before you try to find that client or that target, because you'll have a better chance of success, and making sure that everybody's a specialist and they all know each other and are working together as a team versus some people could be disjointed and the left hand doesn't know what the right hand is doing in a lot of cases.
Yeah, and to jump in on that, particularly with the M&A attorneys, oftentimes we're brought in after the team's been assembled and we have this already signed letter of intent or term sheet or whatever, and there are things that we would have done differently, negotiated differently, probably left out to wait until we've gotten to the point where we see where we are with target or the person who was buying us, depending on what position we are in. That would be helpful if we were involved, the M&A attorney was involved earlier on in the process. And as Scott said, you need someone who's a specialist who deals with these transactions on a regular basis and not the person who formed your company and sort of did your employment agreements and your sort of minor corporate transactional agreements in the course of the firm's life. You need an expert who deals with this all the time, who can bring perspective and a knowledge base that you wouldn't get from your generalist.
Yeah, absolutely. You don't want to pay someone to learn how to do a deal and be it on your deal. I've seen that where it should have been $50,000 to $75,000 fee, and it was about $150,000 fee. So not only did they almost blow up the deal twice, but my client paid double because they didn't want to use the specialist. This is one that I think is really unique, and this is especially if you're buying a founder-owned company or a privately held business. You know, a lot of these baby boomers out there in the United States and others around the world, but don't negotiate too soon. I've seen that so many times where people come in and go, well, this is just a deal, and he's trying to get, or he or she's trying to get the highest value for them that they're selling. I'm trying to get the best deal for me and our team or our company. And what happens is you don't build any rapport. And I've been doing this for a little over 22 years now, and I've seen so many deals where we'll have 5 offers and they'll go, yeah, they have the highest offer, but you know, there's just something about it. I just don't like them, or whatever it might be. So a lot of times they'll pick, what is their gut feel? You know, who do they like better? So again, we call it the proud parent syndrome, that when we do exit interviews, a lot of times our clients, the sell side clients, talk about this is almost like giving up a kid for adoption. And you know, where you're thinking you're just negotiating, the seller could be hearing, boy, you've got one ugly, stupid kid, but here's some money for it. You know, do you want to, it's reality, and it doesn't make any sense, but that's just what it is. So making sure that you build rapport before you negotiate, we found that to be very helpful with trying to get deals done on the buy side. And again, this one goes back to what we talked about in number 2 a little bit, is try to get into that one-on-one negotiation. Otherwise, like the deal that I'm working on right now, you'd be 1 in 28 or 1 in 5, you know, not great odds of trying to get that client in. And sometimes you have to be careful what you wish for, that, yeah, I won, but what did I win? How much did I pay when you wake up the next day after? It's like having a couple of drinks and going to a charity and you're at an auction and you won whatever, but then you end up paying 3 times what you probably should have paid for it, or whatever it might be. But let it be known that you're looking to acquire. So, you know, let your accountant and your attorneys and your blenders and everybody else know that you're looking to acquire. Go to your trade associations, be vocal. Hey, if anybody's thinking about retiring or selling their business, you know, down the road or now, you know, we're here, we're looking to grow. We've got a strong balance sheet. We'll take care of your company. And then again, bring in an investment banker to help you find those one-on-one negotiations versus, you know, just waiting to see what, you know, what's on the marketplace and trying to put a round peg into a square hole, so to speak. And then the last one is really getting the, I've seen a lot of buyers where they'll try to dot every I and cross every T and try to get everything perfect before they put in that LOI. And all of a sudden they wait so long and it stretches out so long that another buyer comes along that's more prepared, understands the rules of engagement, and kind of pulls the carpet out from underneath you. And so you know, I think to get to an LOI and get that exclusivity for 60, 90 days or whatever it might be, and then just be saying, you know, I still haven't dug into this yet, so I'm not sure where I'm going to end up on that, but let's leave that as an open item, you know, to figure out in due diligence. Because again, a seller doesn't like you to come in at the 11th hour, you know, try to retrade the deal, or, yeah, I was going to offer 45 million, but now my diligence, you know, I told you I wasn't quite sure about some things. Now it's 35 million. People don't like surprises, and it's just not a great way to try to get a deal done. But to get that exclusivity and get control of the situation, so now you are in that one-on-one negotiations, I think really does give you the power to negotiate from a power of strength versus, you know, still having other buyers out there that could potentially take the deal from you. Sandra, anything else on any of those points on the buy side?
You know, with respect to the LOI, so, you know, it's going to be a term of art. You want to have enough in there, but you don't want to put too much. And sometimes it's where the M&A attorney experience can come into play to say, okay, you know some things, you definitely don't know everything, and there's bound to be some surprise down the road. So let's put this much, leave some room for some wiggle room, but it shouldn't be a $10 million difference in your price unless it's, you know, you're talking about $100 million acquisition. But the variance, you want to have some flexibility, but it shouldn't be way too many surprises for the seller in terms of what you're going to offer based on what you put in the LOI and what you discover in diligence. And, you know, and I'll probably bring this up later, but with COVID-19, what we've found is it's been taking longer times, you know, those drop dead dates, or those, you know, we got to close by this date. Those have been pushed out a bit. And as we've moved through, and we're now here almost, you know, at the end of the year, we're probably going to see in 2021 those periods coming back down to more normal, because at this point, we've seen what's happened, and vaccine is out. So hopefully that can only mean things are going to get better. So those periods are going to come down, but for now, you just have to. It's a very fine line you're walking. Put enough, but not too much, and leave some room for both parties to have some flexibility on it as well.
Yeah, no, I think that's a great point. And again, on the buy side, if you're even close on price from what the seller wants, I think structure is more important of how you structure the deal, how you structure the payments and everything else is usually going to give you a better chance of success versus getting, paying a lower price, but all cash at close sometimes. And they got high customer concentration or whatever else it might be. So, all right, let's jump into the sell side now. So now for you business owners that are thinking, okay, maybe over the next year, 2, 3, 5, 10, whatever it might be, I'm getting closer to exiting my business. Let's talk about what, how should I plan for that or what that is. And you talked about flexibility, Sandra, and reasonableness. And this is number one mistake is that sellers' expectations. The biggest reason that businesses don't sell is because sellers' expectations are out of whack. And again, it makes sense. There's no real good public comps out there for privately held companies. This is your largest transaction of your life, typically as a business owner. You're emotionally tied to that business. So most times, again, business owners think it's worth more than what the market might bear. And sometimes it's the other, but again, this is definitely number one. So this is where we spend a lot of time doing that estimate of value to make sure that we tell you what you need to hear in order to make a well-informed decision versus just, telling what you want to hear, like about a lot of other firms. And then down the road, everybody's pointing fingers of why the deal didn't get done. So again, kind of a way to show that from a proud parent syndrome is this is how our clients typically come in, very happy. And then we have that conversation and this is what they look like after the fact. This is my daughter when she found out that was the last cup of ice cream, that her favorite ice cream place was shutting down. But that's unfortunately what some sellers look like, but at least up front. So now you can make adjustments. Nope, I guess I can't go to market now. I need to spend some more time building value and focusing on these key areas or whatever it might be. Mistake number two is holding on too long, where again, we see this that a lot of business owners are very passionate about what they do. They have to be to persevere through a lot of the different ups and downs of the company. But what happens, unfortunately, and Sandra, Christy, I'd love to have your thoughts on this. Most sellers hang on and boy, I've been in business for 40 years and I've done well, but so what? I hung on 1 year too long. Well, does that make a big difference or not? And unfortunately, it does. Most buyers will look at that and say, I'm going to look at the last 3 to 5 years, but most buyers put the most weight on the last 12 months, the trailing 12 months. So some put all the weight, like our client right now that we're doing all the weights on the last 12 months. So you could just hold on a percent or 2 or 3 too long in your whole journey, but leave 20, 30, 40% on the table. So what we want to help you with is talk about where is that finish line. You kind of, this is like a marathon. You start off strong and then you kind of get into that rut, but all the coaches go away, the water stations go away, the signs, the markers go away, and you don't know where that finish line is for a lot of business owners. So this is where we can help you understand where is that finish line, take that deep breath, and now sprint to the finish line. And you'll have so many more options and how you're going to get out and get in a higher value than where a lot of people wait for a negative trigger and all of a sudden it's not fun anymore. I guess I should sell my business, or there's a health issue and the business starts to slow down or starts to tank and you lose real value. I guess, Sandra, have you seen that in your practice over the years?
Yeah, in our practice, definitely. So you look at sometimes 5 years of earnings or revenue, and then you look at, but you're correct, that last year, because that is seen as the trend. Is it down? Then, forget how great the prior 4 were. That last one, if that's down, then that's where that's your trajectory. If it's going up, wonderful. But the last year, is definitely the primary focus. And of course, this year was just a really, really extreme example of what can go wrong if you wait too long. I mean, right. I had a client who went to market and signed their deal at the end of January. So, signed and then closed post-COVID. So luckily, they weren't impacted by it. I mean, the buyer pretty much got not exactly what they bargained for, but the purchase price was locked in, and there was no wiggle room because of the COVID impact, because, of when the timing was everything for that client. So yes, you can, wait too long. And as you talked about, the 5-day plan, getting ready. And part of getting ready is, get your house in order,
Right.
fix any problems, because a buyer's going to come and he's going to look and what's this, or how your contract's documented. I mean, the stupid, corporate records, even those things are looked at by a buyer. And is any reason to sort of start nickel and diming and chipping back at your purchase price, because they start to get uncomfortable, or your records aren't that great, so what else is not that great? Are your revenues truly what they are? And so it can actually impact the price you get. It can impact, the earnouts. It can impact, what sort of holdback there is in the purchase price.
Yeah, so I would say as a buyer, one of the key kind of unique takeaways is don't negotiate too soon and build rapport. Here is prepare, and plan, and give yourself a window of when a couple of years of when you're going to sell, and when you're peaking and the market peaks, and everything else, and you can really do well. But don't hang on too long like so many buyers do, because the second reason that business owners sell, number one is retirement. Number two is usually burnout on multiple surveys that I've seen all throughout the years. Last one is just not understanding your value drivers. I'm not going to touch on all of these, but customer diversification and management team are probably two of the big ones. What are your EBITDA multiple or your EBITDA margins? A lot of buyers want to see at least 10% EBITDA margins or better. And then having, as Sandra talked about, having your legal house in order, your HR house in order now, especially with COVID. And then that QOV, doing the QOV up front, we recommend that it's a great investment to have your attorney and your a CPA outside CPA firm come in and basically do the diligence that another buyer is going to do, because it just uncovers anything. And now if there's issues, you can fix those issues before you go to market, versus the buyer finding it, in their diligence, and then either the deal blows up or the value or structure changes. Mistake number 4, again, putting the deal team together. So this is, most business owners try to do this themselves because, hey, who knows my business better than I do? Nobody, and that's true. But running a business and selling a business are two very, very different things. And what's anything that you do great? For those that golf, did the first time you went on golf, were you a scratch golfer? Or if you do one thing well, and think about boxing. If you were going to become a boxer and you said, I'm going to read every book there is on boxing, I'm going to watch videos, I'm going to even get a coach, and then you're going to go in the ring for the first time and be, against a boxer who's 32-2. How do you think that's going to turn out? It's probably going to look like this. And unfortunately, all these buyers have teams that are been working together for a long time. They've got their teams set up. So their job is to get the best deal for them, not to pay, more than they should. So you want to make sure that you have the right team on your side. And like Sandra and myself and others to really help make sure. But otherwise, this is like watching Judge Judy in the United States and thinking you're a judge, or watching Grey's Anatomy and think you can be a doctor. It doesn't work. And that's why the national averages are, 15 to 33%, depending on the size of your businesses. It's a lot of people don't sell because of that emotional tie and doing it themselves and trying to do it, one time in their whole entire life. Mistake number 5 is just that poor planning or poor timing. So again, as you can see here, very few business owners plan ahead. Most of them, it's a reactive. I've got a health issue, or my spouse has a health issue, or it's not fun anymore, or COVID is here and I got to deal with all this stuff. What is all this about? So planning ahead and making a plan will help so much in getting higher value and making it more efficient. And things that you can't control do affect the value. So a lot of people sell, well, I'm going to sell when I'm 65 years old. Well, if you're 65 in 2015 or 2018, great. But if it was 2009, 2002, not great. So you can see, interest rates, lending environment, more buyers and sellers, confidence, the amount of capital out there. Right now there's significantly more buyers than sellers. That disparity has even increased due to COVID. There's records amount of capital. I think it's $1.5 trillion just in the private equity world in the States. It's unbelievable of how many buyers there are around the country. So again, understanding that, because you can get that lift, or if the market, your business goes down, multiples go down, you get that double whammy, either positive or negative, if you're planning kind of time the market a little bit better. And then lastly, just knowing your different exit options. And I think Sandra and her team are going to talk about some of the different options later and what, some of the pros and cons are each of those. But it's not just, let me call my competitor down the road and see if they want to buy my company. Most times that's probably the worst buyer that you can call, because they're going to get a lot of competitive intelligence. And then, I've seen just lowball offers or no offers at all, because now they can compete against you in an unfair advantage. So making sure you've got the right team around you and understanding all the different options and what's important to you. We say, it's not just always about getting the highest value. It's about what's important to you as a business owner. Is it value? Is it structure? Is it staying on longer after the sales or getting out? Is it selling a minority or majority piece and then you're taking the company to the next level? Is it culture? Is it protecting the employees? So many different things to think about. It's not just all about price. And that's some of the things I think Sandra and Chris will be talking about here as we go forward. So Sandra, I'll turn it over to you guys a little bit more. You're on mute, Sandra.
With respect to COVID-19, earlier in the year, late summer, we saw, a rapid fall off in the amount of deals done this year compared to last year, So, it was 1.2 trillion versus, 2 trillion last year. And that was globally, and, 355 billion in the US. You've done about 60% or so from last year. Things are changing now as we have gone through the process of COVID-19 as the year has gone on. Of course, we're still going to be down, but we see that more deals are being done. And, what type of deals we saw were opportunistic deals, the companies that did well, through the crisis, are the ones that are being sought. And as Scott said, there's lots of buyers going after these companies because they have survived. And so the amounts of companies that are viable at this point, aside from ones that were in bankruptcy that maybe were attractive for that a fire sale type of transaction, are few and far between. So the ones that are doing well are the ones. So of course, the travel industry and hospitality, those industries are down, but technology and healthcare booming, right? So companies like do this like Zoom, right? Because how many meetings are we having by Zoom as opposed to what were being done before, telemedicine and those types of things. So those are doing well, So the year is going to definitely be down, but we hope that in 2021, looking up with the vaccine just out now, when the new one should probably be out by early next year. And hopefully, by summer, things will have gotten better. Companies will have recovered. The ones that were, not going to make it, we've sort of seen that's played out now. They're gone, right? They're already, if they're not gone, they'll be gone soon. And the ones that have made it this far are the good targets for acquisitions. Companies that have recovered. I'm sort of moving fairly quickly through the slides. I think we have limited time, and I want to have time at the end for the Q&A. Deal structure changes. Typically, and Chris, I'm sure, has a lot to say on this topic. We have this sort of the stock deals versus the asset deal, of course, and every buyer wants to do an asset deal because they want to cherry pick. They want to get all the best customers and all the best assets, and they want to leave all the junk behind. And so the buyer wants to sell you everything, good, bad, and indifferent. And that tension has always been there. COVID-19 just sort of heightened that. So there's task constitution that Chris can speak to, and so that's still there. What we've seen a lot is a lot of all stock, like stock for stock transactions, so that gives the buyer doesn't have to outlay cash. Of course, there's a valuation issue as to what the buyer's stock is worth versus what the seller's stock is. So there we have seen those types of transactions. We've seen deals now with more cash delayed on the back end. So we'll pay a small amount of the purchase price up front, and then we'll pay more on the back end, and we'll see how the company progresses through through after acquisition and how it weathers the COVID storm, and you'll see if they're hitting their numbers. If they make that, I know I'm sort of out of order on the slides. I'm sort of talking contemporaneously. So, in your typical transaction, you have your pre-closing, right? So you have your due diligence. What we're finding now is a longer process on the front end. It takes a little bit more to get through the process beforehand. We have a longer extended timeline. Due diligence now, which I'm not going to cover very much, is going to take more time because we're minimizing. Typically before, earlier on in the year, there was no business trips, no in-person meetings. I think that's loosened up a bit, but it's not as much as it was before. So it's going to take a little bit more time to get things done at the front end. And then at the back end, the things you would normally do, you have to file this thing within 30 days of closing or 15 days of closing, or you may need some consent or some governmental filing completed. Everything was taking longer when COVID-19 first came about. Some things was completely shut down. Things are now online only. You can't do things in person. Expediting is not working anymore. So things were taking a much longer time to get done. Now we're seeing things loosening up a bit. People have now figured out, how to get things done in the new reality. So they've come up with new systems, they've come up with new machines, technology companies again. I had to go get some lab work done, and it was the fastest I've ever gone into a place without an appointment and moved out. They had a machine, you could check in, you call your information in there, you scanned your card. I was in and out in 45 minutes. Never happened before. Usually it would take 2 hours at least. So we're seeing where processes now are catching up. And, so that actually is a wonderful thing for going forward, because I don't think they're going to unlearn the lessons they have learned through COVID-19. It's been a crucible, and, companies that have survived are probably going to do very well going forward, which, go back to Scott's point that we think that M&A is going to definitely pick up going forward in 2021, and make up for the losses in 2020.
Oh, sorry. I was going to jump in about the equity versus asset deals, because that's very important as to what you have left after. So what the purchaser wants in a mergers and acquisition, typically at odds with what the seller wants. So in a corporate setting, the seller, if they sell the assets are still stuck in the corporation. So you got income gain on the sale of the assets, presumably. And then you got to get those assets out to the shareholders, and that's a second level of tax. And so what's left over as compared to a straight stock sale is going to be much less. So it's very important before setting a price, you understand what the deal is and what you want to get, what you want to have in your pocket after tax. So there's a big difference in that. So typically sellers like the stock sales. The purchaser likes the asset sales, because typically they'd get a higher tax basis in the assets. And when the company that purchased the assets later sells it, there'd be less gain recognized. It's important to point out, and a lot of times it's skipped for people who, for founders of corporations, there's this 1202 stock that can provide quite a large exclusion from capital gains tax on the sale. There's some new things that came in with the pandemic with net operating losses. So with a stock sale, tax attributes can transfer to the acquirer, but you got to be careful. Are there limitations on the ability to take the net operating loss? Under the CARES Act, net operating losses in years 2018 through 2020 can be carried back 5 years, and so you can amend those tax returns, get tax refunds. Whose property are those tax refunds? Does the acquirer get it? Should it stay with the sellers of the company? So these are some things to negotiate as part of it. If it is going to be a stock sale, because it's much easier to proceed with a stock sale, it's possible that you can make an election to treat the stock sale as an asset purchase, and that would allow the purchaser to get that increase in tax basis. Now, given these times, sometimes a company that in distress that we're going to, I had a client who purchased assets that were or was going to purchase assets through a bankruptcy that the company that was bankrupt purchased for 75 million. He was going to purchase it for 400,000. So getting an equity deal for him, stock, would allow, this is kind of opposite than usually happens, by transferring the assets into a company first and then selling the stock, allow to keep the historical cost basis. And so much higher in the millions and millions for the assets rather than the purchase price they actually paid. Okay, we can go back, sorry.
Where would you like,
I think the distress, maybe.
you want to talk about distressed?
You're on mute again.
Sandra, you're on mute still.
As companies, COVID companies, they, companies you can see that were not doing well, and they became an opportunity for buyers to get a company that was not doing well at, bargain sale prices, right? You could get a company for a much discounted price. It can also, if a company is in distress, the seller is motivated to sell before they completely tank, and then nobody wants them. So that presented an opportunity. I think that era is pretty much where the end of that, because companies now, the ones that are still around have weathered the storm and still have value. The ones that are not going to make it are pretty much gone at this point. Part of the distress sale is, as Chris just alluded to, with bankruptcy, buying companies up through the bankruptcy process, whether it's Chapter 11 or Section 353, which is a shorter process and less expensive, and you get some protections from the bankruptcy process, although it's not guaranteed. There could still be some success of liability. Some liabilities may not be discharged, but it does provide some opportunities. I don't know how, Chris, you want to have anything to say on the tax aspects of, going through the bankruptcy process?
Yeah, well, I mean, kind of what we've seen, not so much the bankruptcy that I experienced, but more where the companies simply don't have the cash to make the deals happen. What I've noticed is using for a tax-free reorganization, where a company acquires another company in exchange for stock. And in the one instance that we worked on together, Sandra, there was one asset inside the company they wanted, and they felt it made their other product, when it added to what they do otherwise, much better. So they did a tax-free reorganization. And so that there's ways, not so much in bankruptcy, but cash strap, where the cash is not on hand, that you can still make the deals happen. And that one, it got interesting because there was sweat equity in the company, the target company being acquired, and they wanted to make sure it was tax-free. And then the people who put who contributed large amounts of funds into the company wanted to recognize the huge losses on the exchange. And we were, obviously told by the founders that no, they're fine not recognizing the losses. And I learned soon after their transaction was over that these equity investors were not so happy it was tax-free. So they would have got a large loss, but it's, the people who had the, who put in the work to build the company didn't want to recognize gain without receiving cash in their pocket. So I just wanted to mention that quickly. We move.
Yeah, it's interesting that you can have the push and pull between the buyer and the seller, but also, not all sellers are equal within the company. So the ones with the sweat equity, the ones who had all the information, the company knowledge, and the ones who are in the trenches every day. So they have more information, and those are the ones we were dealing with mostly on the transaction of, and that was, they're fine, but we got it done. And I did another transaction that was a stock for stock deal as well. So that is another option that people have been using. We talk about, we talk about changes in valuation, that how people are valuing companies. And I know definitely you have definitely seen this, Scott. So we typically we have our we're earnings and your EBITDA and all this, but COVID completely disrupted this process, right? So you want to look at your 12 months, as you alluded to before, because the last 6 were just horrible, and that may not be exactly a fair way of valuing the companies. So, we'll see, just some different options. We're going to look at this. We're going to, as I said before, instead of, okay, so your earnings right now look really, really bad, but maybe you recover in 6 months or 18 months or maybe even 2 years. So you have a longer period for the earnout. So we'll pay you a smaller amount up front, and then we'll see how the company does. And so then the seller can get more funds on the back end as opposed to just completely lowering the purchase price based on the last 12 months of earnings. And I guess you've seen that, correct, Scott, in terms of how companies are handling valuation for companies.
Yeah, we've seen that too in our transactions. It's interesting that the ones that haven't recovered yet, we're able to, just because of the competition, we're able to say, yeah, okay, well, here's the value today. And then, we expect to come back over the next 12 to 24 months and we want to get that value back. So they'll use earnouts. But the ones that I think buyers, when this first hit, they like, okay, this is a good time, even for good companies, we can still probably pay a pretty good value, but put more risk onto the sellers. And they found out very quickly that because there's so much competition between the buyers, that they just, if they want to get the deal, they can't just do earnouts for the sake of doing earnouts. There has to be a real material reason to do an earnout. And the values have stayed much higher than they have in the last two recessions that I've gone through, and it's just been an interesting time. And I think, as you said, Sandra, 2020 is anything but ordinary, but 2021 should, continue to, I think, build off of what we're seeing here in the fourth quarter of 2020.
Yeah, because, and I think the reason there's so many buyers is the opportunity is there, but then the amount of value companies to be acquired are just really not there. Hence we have this disparity between the buyer and between buyers and sellers. So as we talked about different type of transactions, the stock for stock, deferred cash, as I talked about, financing, I think, Scott, that's more Scott's neighborhood, but it can be had because, as you said, there are buyers out there, but it's you just have to have the right seller will get the funding. And if the buyer, and there's money out there for acquisitions because there's not many companies to get, so you can get financing, is just maybe a little bit more difficult, a bit more time consuming. Would you agree with that, Scott?
Yeah, I think it's come down a little bit, but not significantly, again, which is a surprise. But yeah, banks are still, there's a lot of lenders that are still open for business, but yeah, it's come down slightly over pre-COVID time frame.
Yeah, and I think also they require more covenants, right? So that they'll give you the money, but you're sort of putting more parameters around what you're getting and, what you can do after you get the funding, and looking at, I think, a more stricter scrutiny of the targets.
Okay.
Chris, did you have some thoughts on this slide?
Yeah, well, I just want to jump in real quick. We're about 15 minutes left. I think we kind of in a roundabout probably covered a lot of slides. I see there were some questions. Maybe we jump to the Q&A and then cover some of the material with the questions we get. How's that sound?
Yes, that's some good things, because what I have right now, not that much very earth shattering. So we can go to the Q&A at this point.
That sounds good. I think one of the questions that we see out there is, maybe my confusion, but what I heard was that there's a lot of buyers out there, and so the question is, how can a business, a small business in particular, right now, kind of react to all of this, with less buyers? But I think it's the opposite problem, right? Isn't there a little bit? You've got the demand out there, even if you're a small business, for selling right now, or please clarify.
Yeah, I would say that as businesses get larger, there's more demand. So if, I think one key threshold is $1 million in EBITDA or earnings. And then, the next one is 2 million. Once you get over 2 million in earnings, it opens up a huge pool of buyers that otherwise might not be interested. But a lot of these private equity firms and family offices are even coming down below the $2 million threshold, down to maybe $1 million, just because there's just so many buyers out there that keep moving downstream until they can find a company that makes sense for them to purchase. But the businesses that are more sub $1 million EBITDA, there's still a lot of buyers out there for that. There's always that marketplace, but those are more individuals buying companies. I think we're talking a bit more of, other companies, private, public, and private equity family offices buying companies. There, it's probably over $1 million in EBITDA. I don't know, Sandra or Chris, do you have any other thoughts on that?
Yeah, I would agree with that. It's just that, the disparity is because so many companies, the target pool is small. And, the private equity companies have seen a value and an opportunity to get in and make investments now, with probably a lower purchase price than would typically be available. As Scott said, that's changing, and things are moving back up. But there's just so many companies that have just not made it, and then there's so many who would like to sell because they want to get out. Forget about burnout. I mean, running a small business in this year was extremely, extremely stressful. So there is that push, but those companies who are, not every company is going to be a viable target for purchase. And so that's why you have this, it's not that there's so many more buyers, it's that I think there's just less viable targets, hence the disparity.
Okay. Yeah, that makes sense. So Christopher, thanks for your question, and thanks for the thank you. That sounds like that was answered. So definitely keep the business, get the business at least $1 million EBITDA, ideally 2, and things open up. That reminds me, when I hear that 2 million, I've heard that threshold before. And one of the things, it's interesting to hear this conversation, and maybe it's Scott, your own perspective about the Wisconsin market. A lot of what I hear, you talked about a variety of issues. You did mention cold feet, and that's actually the one issue that I've been hearing the last several years, of maybe not enough buyers, in the market, and people, dropping out, either one side or the other, either on the buy side where they change their mind, or more frequent, or very often, the seller who feels like they're undervalued. You talked about that issue about getting higher expectations than reality, and not getting the number that they need, gets them to back out. So I'm wondering how the current market conditions should be looked at. If somebody's got looking to evaluate where they are today, what's the future look like, and where are we headed with sales prices? The U.S. capital gains tax, it's not going to immediately happen, but it's probably going to be roughly doubling. And you've got foreign investment, coming in, hopefully a little bit more next year. And so you've got these various factors that could be driving prices up, but there are other factors that drive prices down. So where are we in the pricing?
Yeah, I would say, I guess a couple thoughts. Depending on the company, the industry, and what it's doing. For the companies that have, were down, negatively affected by COVID, March, April, May, but then came back, June, July, August to 19 numbers or better, or those that really just weren't unaffected at all by COVID and kept pushing right through, and the small minority that actually gained and were positively affected. Those companies are very, very sought after right now, because it's you've gone through a recession. You're kind of COVID proof. And as Sandra said, because so many people were negatively affected, pulled themselves out of the market, or didn't go to market when they thought they were going to go. And those that even are doing well said, boy, with all this craziness going on right now in COVID and the election, this could be a good time for me to maximize my business sale, because so many people have left the market. It's ironically that reason that multiples are actually pretty good. The first 3 quarters, according to GF data, multiples were actually up in 2020 over 2019, and 2019 was a good year. So we've had a really good run for business owners from 2015, through 2019, which usually the last ones were like 2.5 years. This was a 5-year run. So I think 2021, there's still going to be a lot of buyers out there, as Sandra talked about. There's going to be a little bit more normalcy and the vaccine coming out. We expect it to be a good year, and we think more sellers are going to come on the marketplace, because as Doug, as you mentioned with taxes, just simple numbers and take out basis and everything else. But if you had a $10 million company right now and sold it with a 20% capital gains, you net out 8. Well, you could bust your butt, work really hard for 2 or 3 years, get your company up to 12 million. At 39.6%, you'd walk out with 7.5 million. So again, what we always say is get a value now, sit down with an investment bank now, understand what the value is, and realistically sit down with your CPA, take a look at what are you going to net out after this thing? What's that? What are you going to, after debt and taxes, fees, and then sit down with your financial advisor and say, okay, here's all my assets, here's all my debt. Is there a gap? And if so, how big is the gap? What do I need to live my ideal lifestyle? And if that net number meets that, meet or exceeds that lifestyle number, well, then you can confidently go to market, because you're right. A lot of people pull out on the sell side of a deal because they just don't know, is this enough? Am I getting enough? What's market out there if they're only dealing with one buyer? So it takes some of that psychology out of the air and helps you make better informed decisions moving forward. But yeah, I think it's going to be a strong year. It's strong multiples for a lot of different reasons. Sandra, Chris, any other thoughts on that?
Yeah, I mean, the tax side, I have a number of clients that they're concerned about the capital gains tax rate increasing. And one client in particular, he's about to sell his business probably in the $20 million range. And it's located in Virginia. And just some things you got to think through. Virginia has an exclusion for capital gains tax if the business was in Virginia. And he has a Portugal business that he owns individually right now, but it's really tied to the same business. And by transferring the Portugal business to be held under the ownership of the Virginia business, he's a Virginia resident. He avoids all Virginia income tax on capital gains recognized on the transaction. He's very concerned about the federal capital gains rates increasing, and the payment structure. The final payment was going to be the first month of January 2022. And if there's tax legislation, it's probably likely going to be effective. It's not unheard of. I mean, it's not that they couldn't go retroactive, but it's probably likely that 2022 would be the year. And it's determining, can we accelerate the gain? So even though it's not paid until 2022, that you can recognize it in 2021 at lower rates. You got to think about that in right at the beginning. When you don't know whether the rate's going to increase. So just kind of thoughts that I have working with clients.
And that's why it's so important to work with someone like Chris, because there's so many complicated ways that you can do to save dollars and save tax dollars that really can put a lot of dollars in your pocket. And I agree, the research that we've done too looks like interest rates or taxes going up in early 2022 most likely is what we've seen as well. So we've got a year to try to figure this out for some clients.
This is a question from Maimun. Thank you, Maimun, regarding investment overall for startups. Do you guys touch the market for startups as well? And do you have a sense of kind of the cash that's out there and the trend?
We don't do startups as much. We deal with more existing mature companies, but the little I do see, it seems to still be positive, because the market's so volatile that people are like, where can I put my money and my investments? And so we haven't seen that from what we've heard change significantly. But Sandra or Chris, do you guys work with startups at all?
Yeah, we do work with startups, and maybe a little bit more of not established, but got your first round of financing and are looking for additional, your Series B financing. And so we've definitely seen work, consistently throughout 2020 for companies, fairly early stage companies who are either bringing in investors to get to the next level or actually being acquired. So they maybe have been around 5 years or thereabouts and have a viable business plan, a viable product or service, and are being acquired, and that's have been attractive because of that. And so, go ahead.
Oh no, I was just gonna try to add on that after you. I've seen a couple of startups kind of switch what their business line is. I had a company that was a startup doing manufacturing or electric cars, and they switched their manufacturing plant to they created a see-through N95 mask, and during this time, because they thought that'd be very profitable, and now they're trying to spin the two kind of concepts apart. Is why they brought me in, because they think the N95 mask can essentially be sold very profitably. So there's some kind of changing of business direction as well for startups, given what's going on with COVID.
Got it. We're coming to the end of the hour, and so we only have a few minutes left. And so what I'd like to circle back on is have you each just make some closing comments, maybe about a minute each. I'd like to start with Scott. And in addition to your closing comments, Scott, could you just do a quick contrast of what you see in Wisconsin versus the rest of the U.S. relative to what we've been talking about? And you also have a footprint around the world, and you're building out an M&A network globally. And so, you know, a minute is a short amount of time to cover kind of like that whole picture. But what kind of sensibility do you have about what's happening and what we can expect going forward?
Yeah, I would say, you know, Wisconsin versus, you know, the rest of the United States or the world, it's a little bit more your traditional businesses. So that we don't see the highs and the lows. So it's been a little bit more even keel. I think the biggest issue businesses are having is trying to find good people. And we see that all over the place of trying to get good people. So I think, you know, those who have good HR strategies will really benefit during these unique times. But I think that ironically, business owners, even during this recession, the ones that are selling, again, as I said, is if they're doing well or recovered, are getting top dollar, better than they might have got some industries pre-COVID, which is just completely doesn't make any sense and counterintuitive. But we think that you know, with good values, strong buyers out there in the marketplace, and as Chris pointed to, you know, this looming probably 2022 tax increases, we think it's going to be a very active market, you know, both in the United States and around the world as just things get back to a little bit new normal and the vaccine rolls out across the world and people are travel a bit more and a little bit more open to make bigger bets on businesses.
Sounds good. Sandra, do you have a wrap up?
Yeah, so, you know, as I said, looking forward, you know, we're expecting to see, as we said before, more deals, you know, private equity playing a much more heavier role or as heavier role as they did in 2020 in terms of financing. And, you know, tech companies, you know, did very well this year and will continue to do well, I think, going in next year. You know, there's some things that were put in place in terms of documentation that we expect to carry on, and maybe, you know, stuff that we've learned, you know, because, you know, I used to do a lot of commercial leasing, and there was always this thing about, you know, some disaster, and you'd have to leave your building because of the disaster. And as attorneys, we paid absolutely no attention to those provisions. It'll never happen. And then Hurricane Sandy happened, and that provision came into play in every lease, practically in Lower Manhattan. And so now we look at MAE clauses. It's kind of like a boilerplate. You don't really pay attention to it. But now with COVID-19, depending on how those were drafted, it could make a big impact. The deal I alluded to before, based on the way it was drafted, COVID-19 was not an MAE for my client because of the way it was drafted, even though the target company lost a large percent of their revenue because they were in the investment advisor space. And of course, the market tanked early in the year. So I think the drafting lessons that we learned in 2020 from COVID-19, I think are going to carry forward into documents, and people will start paying more attention to what we normally think of as but that doesn't matter. That never happened, doesn't matter. But, you know, it happened. The unbelievable happened in 2020. But I think there will be, as I said before, growth going forward, and, you know, the right companies will be able to, you know, to get a good price for their companies at good multiples of their revenue, because they've weathered this storm. And, you know, that's like you've come through the trial by fire and you're on the other side intact and doing well. As Scott said, you will be able to, you know, command a good purchase price for your company. I do expect that M&A will pick up once we get, you know, further into 2021. And as we also see, hopefully, the positive impact from the two vaccines that are, you know, one's out now and one should be out, you know, pretty soon.
Very good. What doesn't kill us makes us stronger, is what I heard from you.
It's so true. Unfortunately, it killed, but in fact, was to say, you know, quite a few of us. But The rest are we're moving ahead, and lessons learned, and we definitely, it was a hard lesson, but I think we all learned from it.
We did. Christopher, we have about a minute. Do you have a wrap up too?
I'll just add, I mean, I think there'll be increased activity. A lot of private equity firms sat on the sidelines, and now they're kind of hungry to get back in and put their money to use. From a tax standpoint, taxes impact everything. So a U.S. company can try to buy something in another country. U.S. tax is still going to be a factor. So they keep me busy. But more to like Scott and Sandra's point, it's important to have that deal and team in place. And if you're looking to go global, it's not just a U.S. based team, right? I don't know if the company's going to be acquired, let's say in Spain or something. We need to get some Spanish professionals in there to get everything structured properly, and you got to kind of think it all through. Just quickly touch on diligence. We didn't get too much into it, but for the buyer, it's very important that you get what you're paying for, and or if you're not, if there's potential liabilities out there, it's important to know. One of them could be, have they paid all their payroll taxes? Have they classified their employees correctly? Because the IRS is very, very quick when it comes to trust fund penalties, and that will succeed typically if you do a stock purchase. There could be other successor liabilities. So just from a global scale, I think it'll increase. M&A activity will increase, and do your due diligence, understand the tax structure, and make sure you have the team in place.
Sounds good. Christopher Klug and Sandra Honegan-Pounder of BurgherGray, thank you very much, based in Washington, D.C. But as you mentioned, you've got offices across the U.S. And Scott Bushkie of Cornerstone Business Services, who's staying warm in Wisconsin right now and has the clarity of the clean, fresh, cool air to be thinking about what's in store going forward, given what we've been through, what we've survived, and we definitely have survived. So I want to thank all three of you for your insights and your information. The next step will be, we'll post a blog post sometime over the holidays with a recording. So that goes back to one of the questions that we had. So that's our expectation, unless something technically goes wrong, but that's what we're expecting here, because this has been a valuable conversation. Thank you, everybody.
Thank
you. Before we close, I just 30 seconds on kind of what's next. This is the final week of really kind of our programming. It's actually, our last programs. We have two of them on the 22nd, a week from today, and we have programs all this week, mostly connecting events. And so Global Chamber does educational events like today that are very valuable for business owners and others who are growing, but we also do connecting just to connect. And so we have a global women's networking tomorrow. We have a virtual league of nonprofits on Thursday. We have a couple different meetups from some chapters on Wednesday and Thursday. We have the extraordinaries on Friday, which is connecting business service providers who are extraordinary with each other and build the business referral network. We've got conversations next week on Tuesday that wrap us up around different topics for Globies. And so jump in, let's continue to build the foundation for success from an international perspective. And just remember to get ready, whatever you end up doing over the next several weeks. By January 4th, Monday, January 4th, please be ready to hit the ground running, because we'll probably have at least 10 events that week to get you involved with resources like you've seen today, or information that'll help you be more successful. So again, thank you all. Thanks to our speakers. Thanks for everybody for attending. Have a great rest of your day. Take care, everybody. Bye-bye.
Thank you.
Bye-bye.
Bye.